Let's now start with accounting for depreciation and disposal of non-current assets. So when we have the non-current assets and depreciation is applicable, now we have to calculate the depreciation and account it, as well as sometimes later if the asset is no more required or usable, can be sold off. So that's what about disposal of non-current assets. So depreciation is nothing but permanent gradual decrease in the value of the fixed assets. Okay, that is called depreciation due to usage, wear and tear, and passage of time. The portion of the cost of your fixed assets consumed. You purchased an asset for $1,000 and for the first year you used it worth 200. Hereafter the sale value being only 800. Means out of the $1,000 worth asset, we consumed 200 worth dollar. No, 200 worth asset. No, this will be called as your expenses named as depreciation. So during the accounting period. So we have to identify that. The costs of depreciation being physical wear and tear. Okay, deterioration like wear and tear. Machinery parts wearing out, vehicle engines losing efficiency. All these things will be good example for physical deterioration. Economic reasons due to obsolescence. For example, old computers replaced with the new models. Old computers still functionable, but because of the new model, we simply shifted ourselves from old to new. Passage of time. The patent leases and motor vehicles will have 5 years or 6 years. Like once year one is over, 1 year's worth may be lost. That's what about passage of time. Depletion. Depletion is applicable for the natural resources like mines, oil well, and quarries. In a small hillock, no, you can extract the stones, break and take the stone out. Because of breaking the stone, the hillock will be no more sometimes later. This is what about the depletion of these natural resources. These are the reasons or causes of depreciation. And why depreciation is charged? Why depreciation is charged? So depreciation is charged to find out the true value of the balance sheet and fund for replacement, avoid overstating of profit, and match the cost of the assets. For example, you spend $1,000 for material, $500 for wages, labor, right? And we purchased a plant and machinery for manufacturing this item. Okay, furniture is produced with the help of some machine. The machine value being 1 lakh. Machine value being 1 lakh. Now this 1 lakh is not expenses, but using the machine, if I manufacture the furniture, the machinery's value will go down. No. Now we have to find out how much of the machinery value will go down because of the usage. Probably this machinery can be used to manufacture around 100 furnitures. It means for every furniture we lose 1,000 rupees. So now this 1,000 is called as depreciation for manufacturing the furniture. Hereafter the furniture value cost being 2,500. So unless we add this furniture, we cannot find out the cost properly. Sales is nothing but the profit is nothing but sales minus cost. If the sales being 3,000 rupees, if you don't know this cost, you may supposed to subtract only 1,500 where you think your profit being 1,500, but really it's not correct. Only after adding this 1,000 as a cost, then the cost of the material being 1,500, furniture being 2,500. Now the correct profit is 500. To determine the cost of the asset, means cost of the goods manufactured, and avoid overstating profit, to find out the correct profit. This is overstated profit. This is the correct profit. Year on year, because of the usage, the machinery value is decreasing. No. If you use for a longer period, the value depreciated to only 5,000. What does it mean? As the value is only 5,000, new one. So provides funds for replacement. Avoid overstating. And also matching cost. If you don't match this cost for this asset, this material produced, then you will not be able to find out the proper cost. So match the cost of the assets with the revenue. So this will be the matched cost. This is unmatched cost. Only then you will be able to find out the cost and profit also be correct. So for the cost calculation, for profit calculation, for proper true value of the asset in the books and replacement of your assets, for all these things, this depreciation is charged. Now, how do you account? In case of depreciation, this depreciation is a debit and it will be directly accumulated in the accumulated depreciation account or provision for depreciation account, it is credit. Depreciation is debit, accumulated depreciation is credit. So, in case of methods of depreciation, we have straight line method of depreciation, method depreciation, and revaluation method depreciation. So, we have three methods of depreciation. You have to be master with that. In case of straight line method of depreciation, assume that the asset cost being 1000 rupees, after a few years of usage, the scrap value or residual value being only 200 rupees. Okay, then due to 4 years usage, that's how we will assume. Due to 4 years usage, the value becomes 200. Clear? Now, find out what is the amount of value lost because of usage, named as depreciation. Cost minus realizable value divided by this 4 years is named as life of the asset. Okay, life of the asset. 1000 minus divided by 4, 200 will be called as amount of depreciation. Can you represent that in the form of percentage? Also can be done. That is called rate of depreciation. In case of rate of depreciation, you can calculate this way: depreciation divided by cost in 100. So depreciation being 200, the cost of the asset being 1000. So for 1200 means this value being 20%. 20% will be the rate of depreciation. Is that clear? And what are the advantages we have in case of straight line method of depreciation? It's very easy to calculate it. We have calculated just like that, and useful when the asset provides equal benefit for each year of its useful life. This asset gives you more or less 200 rupees worth of benefit every year for the 4 years. Only then this method will be applicable. And what could be the disadvantages in this method? Need to estimate the residual value of the asset. So while purchasing, you know what is the value you purchase. Okay, but 4 years later, at what rate it will be saleable, also be a question mark. And next one is, will it be saleable means it will have the life for 4 years, also be a question mark. Okay, that's a problem here. Okay, now need to estimate the residual value will also be crucial, and ignores the actual loss of the value of the assets. We thought after 1 year's usage, 200 rupees might have been lost. Now the value is 800. But it is only approximate calculation, not real one. Practically, the value may be either 300 lost or 100 lost, but we never bother about the actual one. So we never bother about the actual loss. Is that okay? So the calculation of depreciation, rate of depreciation already we have seen along with an illustration. Now, in case of reducing balance method, what is the advantage? So the advantages for the reducing balance method, it matches the cost with the revenue. Okay, this is a proper one. Okay, because in case of asset, if you purchase for 1000, right, this is the cost. And what about the incidental cost you have to incur? Repair. Okay, in the very first year, no, you don't have any repair cost. Probably you assume the repair cost overall, the life period being 1000. In the very first year, usually you have the repair being 100. In the second year, the repair may be doubled. In the third year, it may be tripled. In the fourth year, it may be 4 times. Okay. So the overall depreciation being 1000, repair being 4000 rupees. If you follow straight line method depreciation, every year you are depreciating 250, 250, 250, 250. Then what about the overall cost you are debiting for this asset in your P&L account, in your income statement? 250 plus 100, 350. 250 plus 200, 350. And 250 plus 300, 450. 250 plus 400, 650. So as year increases, then the loss is also increasing. Logically, old asset leads to huge cost for the repair. If you are demanding huge cost for the product you manufacture, or demanding more cost for the consumer, they are unhappy. They will be happy for the lower cost with the new product, right? So this seems to be not logically correct. So in that case, what happens, this amount is depreciated this way. Higher value is depreciated in the very beginning, thereafter gradually decreasing. This method is usually what model represents. It's called reducing balance method. Okay, reducing higher depreciation in the beginning and lower depreciation the later on. But if you follow this method, the overall amount transferred to the your income statement being 500, 500, 500, more or less the same amount you are debiting for the asset utilization over the 5 years period. So logically seems to be good one. Okay, so that's why it matches the cost with the revenue. And it's useful for those assets where greater benefits are gained in the earlier years. So huge benefit will be there in the earlier year. Outdated or old machine will perform much lower and the benefit also be much lower. That time we charge only 100 rupees. What are the disadvantages? The depreciation has to be recalculated each year. So every year you have to recalculate what is the amount of depreciation we charge, and that's a problem. And the depreciation charge against profit is greater in the earlier years. The earlier year, no, reducing balance method. The last method is all about revaluation method. And the revaluation method, no, this will be suitable for the small value items. Small value items. Okay. Probably you have a small stationery and nuts, bolts and all. No, you cannot value. And it may be very easy. Advantages: estimated the useful life is not required. You cannot estimate. You don't need to worry about the life not required here. Simple calculation. Every year the assets are revalued. So you have few assets. Day 1, what's the value? Day 1 is due by the day end, nth period. The nth period, the value being 600. Naturally, the difference between these two, 400 is depreciation. Next period, 600 is the opening value. What is the current value by the end of the second year end? Second year end, it may be 350. Then naturally 250 will be considered as depreciation. That's how we can calculate the depreciation under revaluation method. But here you have to do the revaluation every year end. That's a drawback. The valuation may be based on the personal opinion. The valuer may have his own opinion, so that may lead to totally different valuation also. We cannot rely on that. So this is the problem of revaluation method. Hope you will be now able to understand all these things. Now, while accounting, what you have to understand, okay, how to record. This is the most important component for solving your illustrations. I will give the format, and before go for the format, I will give the steps here. Recording related to the assets. When the asset is purchased, simple, asset account usually debited and cash, bank or supplier account credited. If the asset is purchased by paying cash or bank, or maybe payable later, means immediately write the supplier's name. At the year end, what you do? No, first step. First step, you have to create the depreciation. You have to create the depreciation in your income statement. So what's the entry you pass? Okay. Income statement debit and provision for depreciation account or accumulated depreciation account should be credited. So you can pass this way also, depreciation to provision for depreciation or accumulated depreciation. Later this depreciation is transferable to the income statement or to depreciation. Is that okay? Depreciation. This is what about debit, credit, debit, credit. If you club these two, debit and debit cancel, so you will get income debit, income statement debit, provision for depreciation, credit. This is the simple one for claiming the depreciation. Okay. While posting that in the balance sheet, income financial statement, asset will always be debit balance. Provision for depreciation no, always be named as credit balance. You should not worry about that. If you have asset being 1000 and depreciation on this being 200, this will be called as asset. This will be called as accumulated depreciation or provision for depreciation. Provision for the depreciation. Asset will always have which balance? Have debit balance, opening debit, closing debit. And in case of accumulated depreciation, it should be credit balance. So second point to be. So what are the points you have to understand? How can you record on purchase that you might have studied in earlier chapters itself? At the year end, you have to provide the depreciation. For the provision of depreciation, you charge the income statement debit and provision for depreciation account credit. How about the balances of the assets and provision for depreciation by the year end? Second, here asset will be always debit balance, provision for depreciation being the credit balance. If you close the asset, what you have to do? That's what about the last case. Anyhow, I'll give the ledger format to make you understand. Then I will explain the last point here. Okay. Let's start ledger format. Now, now, what are the ledgers are to be prepared? What are the ledgers are to be prepared? Okay. I'll give the format. Three predominant ledgers are to be prepared. Three predominant ledgers are to be prepared. Number one being that concern asset account. Concern asset account. Number two being accumulated depreciation or provision for depreciation of asset account. Provision for depreciation of asset. Depreciation of asset. If you suppose to sell any of the asset, it will be routed through a new account called disposal of asset account, the third ledger. Disposal of asset account. You have to understand these three account format. Now, come on, tell me, guess yourself. What happens in case of asset? Asset means opening balance should be in the debit side, balance brought down, and closing balance should be in the credit side, balance carried on. Balance carried on. If the asset increases, should be posted in the debit side as debit. To increase that, it should be debited further. To reduce, it should be posted on the credit side. Posted at the credit side. To increase the asset value, we need to purchase. So, bank, cash. If it is not paid immediately, then supplier's account will be named here. This is what about the purchase case. We already studied here. On purchases, asset debited, cash, bank or supplier account will be posted. So, first one is over. Then, what happens here? Whenever you sell the asset sold, is transferred from asset account to asset disposal account. So, here, disposal. This will be transferable directly, disposal of asset account. Directly transferable to this place, asset account. Okay, that's how we can transfer. That's all. So when you purchase, it will increase. When you sell, that asset is transferred. So it will be automatically tallied. This balance carried on becomes the balance for the next period. Opening balance brought down. Very simple. Now you will be able to understand the asset account. In the case of provision for depreciation, it's a reversal. Means reduction of the asset is accumulated in the provision for depreciation account. Provision for depreciation account will be credit balance, asset being debit balance. So because of that reason, opening balance brought down should be in the debit side, balance carried on should be in the credit side. Whenever this value is increasing, should be credited. If it is decreasing, it should be debited. When it is going to be increasing, every year you are adding the year's usage of the assets named as depreciation here, should be posted here, usually named as income statement. This is nothing but depreciation for all the assets for the current year depreciation. If any asset sold, the sold assets depreciation since the date of the purchase to the date of sale remains in the provision for depreciation, no more required, is transferred to the disposal of asset account. So, disposal of asset account. Okay. This balance carried on becomes balance brought down next. So, this is transferred here. provision for depreciation of asset. Very simple. You have two items here and two items here, debit and credit. Here we have two items in the credit side and two items in the debit side. Now, to make you still see everything in minute, let me see. It will be original cost at which you are going to show. Original cost. All these things are shown at the original cost. Clear? That you have to understand. Now, what about this one? The amount. This is the depreciation for all asset in the current year. For what year we are working? No, for that year's amount will be posted here. What about this one? This is what about the depreciation on the assets sold, okay, from the date of purchase to date of sale, purchase date to sale date, to that extent whatever the total server. Now finally we get back to this disposal account. While disposing, asset value is appearing at cost and accumulated depreciation on the asset sold, depreciation on sold assets since the date of purchase to date of sale. This one total 1000 rupees year in, first 200 rupees depreciated and another 150 depreciated, another 100 depreciated, 550. Now this will be called on asset sale. If this asset is sold, the difference between these two will be the accumulated depreciation, 450. That will be called the depreciation of the asset sold. This will be 450. If you are preparing for this year, this will be 100. Is that okay? You will be able to now understand this is the depreciation for the assets, all the assets put together for the year. This is what about the depreciation for the assets sold since the date of purchase to the date of sale. Okay. Now, if you are selling, you will get the disposal for cash. Disposal for cash. Now finish up tallying this. You don't have any balance here. If you tally, because of the disposal, you will either get profit or loss. If you get the profit, that will be transferable to the income statement, appears here, income statement, named as gain. If it is being the loss, should be shown here, income statement, named as loss on sale, loss on sale. You will get one of these two. Hope you will be now able to understand the preparation of asset account, provision for depreciation on asset account, and disposal of asset account. All clear? Now, how can we calculate the depreciation on asset disposal, sir? This value. I just further go explaining here. Number one, how do I calculate this one, sir? Fourth working note. Depreciation on asset disposal. On asset disposal. Okay. Now here, cost 1000 minus depreciation since the purchase to sale, since the date of purchase to sale date, that will be subtracted. So what value you have after this depreciation, you know, called net book value. So from this, very clear, if you have been given net book value and cost, the difference between these two is the depreciation on the asset sold since the date of purchase to the date of sale. Now, how do I calculate this one, sir? Amount transferable to the income statement. Depreciation for all assets. I'll give the format for this one also. Okay. Current year depreciation for all assets, okay. cost, previous year depreciation, net book value, and from that net book value only you have to calculate current year depreciation. Okay. Now, depreciation means this will go there. And depreciation up to the previous year end. Okay, from this if you subtract you will get the net book value. For example, 1000, 200, 800. This is what about the first year depreciation. Second year depreciation you subtracted 150. Today it is 650. Now for the current year you are supposed to create another 150. How can you show? 1000 depreciation up to the previous year being 200 plus 150, 350. Net book value in your book being 650. Current year depreciation being 150. After that the closing value being 500. That's how you have to show. You have to break all these things to find out the depreciation up to the previous year and depreciation for the current year and all. Clear? And for the new asset, any new asset you have, this is disposed asset, next one new asset. Other than asset exists since the very earlier period, not sold in this current year, balance asset. So you can have this asset being classified into three assets. All asset represents disposed asset, newly purchased asset, not newly purchased asset, not disposed asset exists since very old asset, other assets. Okay. And for the new asset, cost and depreciation up to the previous period will not be there. And you can calculate the depreciation on this, okay, on this. Clear? Balance asset, accumulated depreciation on that up to the previous year. Net book value as on the year beginning. Current year depreciation on this will be this one. In case if you are following reducing balance method, you have to calculate the depreciation on this reducing balance method. If you are following SLM method, only based on the straight line method, means original cost you will be calculating. This is called SLM method, straight line method. Cost 1000, depreciation 400 already depreciated, today 600. If the rate of depreciation being 10%. If this reducing balance method, your depreciation being on this 600, 10% closing NBV to be shown, right? So this working note will help you to solve the illustration much easy way. Is that clear? Now, how this will be appearing? How this will be appearing in your financial statement? One is all about income statement. One is all about income statement. Another one is financial position statement. Financial position statement. Under income statement, this will be what? This will be the second one will go here as expenses depreciation. Expenses depreciation. Not only that, on sale you will get loss also. This will also be. I'll put the hash symbol representing all these items. So loss on sale. Loss on sale. In case of gain, that will be shown under income. Okay, beforehand you can show this being the income. Okay. What are the income we have during this period due to the asset disposal? Okay, gain on disposal. Gain on disposal or profit on disposal. It will be shown under this, especially assume this is being the plant, write this being the plant. Write the cost first of all and write the both the depreciation up to this, accumulated depreciation up to this year, and find out the net book value. Subtracting this, you will get the net book value. This is how you can show. Three ledgers for. So master with this format. Let's now solve some illustrations here. The format is also given in text, so you can refer this also later on. Okay, depreciation on asset disposal and current year depreciation of all assets. I'll explain the last component later on. This is all about revaluation method. See, it's very simple. Let me finish up this also just like that. Under revaluation method, you know how the ledger being the asset account. Also asset only know opening balance brought down should be in the debit side, balance carried on should be in the credit side. Okay, the debit and credit. If the balance increases, should be posted in the debit, and if it is decreasing, posted in the credit side. So if you purchase, then the balance will increase either by paying cash or whatever it may be. But we usually consume, and we assume that we cannot track the sales. In the year beginning, we have 1000 rupees. In the year end, you just go and value how much of stock you have or asset you have. If you think that you have only 600 rupees worth stock, so 1000 will be the opening balance, 600 will be the closing balance. Meanwhile, you purchased another asset for 100. 1000 plus 100, 1100. From 1100, 600 is subtracted, 500 is missing, is assumed to be lost or depreciated. The depreciated will be transferable to the income statement. This is transferable to the income statement. Is that clear? Balancing figure. This amount is similar to the depreciation like. You have studied this in the stationery account in the earlier chapter. Other receivables and payables. Stationery also similar to the same one. Okay, opening purchases and closing and balance is transferable to the income statement. The same happens here. This is what about the revaluation method case. It's very simple and the balance can be brought down to the next year. Let's start with the first example. Want to prepare here? Prepare fixtures account and provision for depreciation account for the year ended. Balance each account and bring down the balance on 1st January 21. Prepare fixtures disposal account also. So 3 accounts are going to be prepared here. Carrying 8 marks. 5 plus 3, 8 marks. Just like that you can get this 8 marks. Okay. Let's try to solve this one now. Okay. So what are the ledgers are going to be prepared? Fixtures account. I'll finish up the format and then accumulate provision for depreciation account. Provision for depreciation of fixtures account and disposal account. Disposal of fixtures account. Fixtures account. Disposal of fixtures account. Now we'll try to finish off format first. Balance brought down, balance carried on. If you purchase new asset, bank account here or cash account. If you dispose, that will be transferable to the disposal account. All these things are appearing at what value? Cost. In case of provision for depreciation, opening should be in the credit side, balance brought down. Closing should be in the credit side, balance carried on. Right. Okay, whatever the depreciation for the all assets for the current year, okay, that will be posted here. Income statement. Income statement. What is this? Depreciation for disposed asset, new asset, as well as balance assets, other assets. And what about here? Any asset disposed, for that depreciation created from the date of purchase to the sale will be posted here. Okay, I'll write here disposal of fixtures asset. Disposal. This is nothing but depreciation of the sold asset since the date of purchase to the date of sale. Since the date of purchase to the date of sale. Clear? These are the values. These are the values. Right. Only these items. First, try to understand the format, then you can solve this illustration easily. Brought down the balance also for the next year. Balance brought down. Similarly, here balance brought down. In case of disposal of fixtures account, how this will be appearing? This will go here, fixtures. From the original cost, no, it is transferred here. Right. Similarly here, provision for depreciation is transferred here. If you sell the asset for a cash, so bank will be posted here. On sale, you will either get the profit or loss. In case of profit, so profit on disposal. In case of loss, loss on disposal. Finish of tally, this will be automatically tally. I now completed the format. Now you feed the details here, automatically it gets closed. And before that, you can prepare another format also. What's that? Depreciation on the asset disposed. Cost, depreciation, accumulated depreciation on asset disposed. Asset disposed. This format. Okay, this format. Cost minus depreciation net book value. For the disposed asset. Cost minus accumulated depreciation. You'll get the net book value. One more step. To find out the depreciation and all, depreciation for all the assets. Depreciation for all assets. All means disposed asset, newly purchased asset, balance existing asset, its cost and depreciation up to the previous year. After subtracting, this is what about the net book value in the beginning, opening value. Now you can calculate the depreciation for the current year. This is accumulated depreciation. Is that okay? This is the format. Let's try to solve this illustration. An extract from JAS statement of financial position on 31st December 2019 showing the following. Cost fixtures. This will be shown where? Here. Initial value 1,15,000. Accumulated depreciation on that 77,625. Net book value is nothing but the difference between these two. Okay. Total cost being 1,15,000. Accumulated depreciation being 77,625. The net book value of all the assets as in the year beginning 37,375. You finish up writing this. Okay. During the year ended 31st December 2020, the following transaction took place. 1st January 2020, fixtures 30,000 were purchased by check. So new fixture purchased on 1st January 2020. The value being 30,000 we purchased. Okay. 30th June 2020, fixtures were sold for $6,000. Sold. Bank amount realized being 6,000. Disposed asset, which was received by check. Okay. These fixtures had originally been purchased on 1st January 2018 for 20,000 rupees. This is what about the cost of the asset disposed. Cost of the asset disposed. This was originally purchased on which date? 1st January 18. Date of disposal being 30/6/20. This period, this asset was used. Now we have to find out the depreciation for this period. That will be the accumulated depreciation to be posted here. We'll work out that later on. JAS depreciates fixtures on straight line basis. She assumes fixture will have a useful life of 4 years. Straight line basis. At the time, the residual value will be 10% of the original cost. Depreciation is charged for each part of the year also, which the fixtures are owed. Okay. Now, the disposed asset, their cost being how much? 20,000 rupees. Okay, new asset we purchased for 30,000 rupees. Okay, so including the new asset, it should be 45,000. This 1,45,000, how do you get? 20 plus new asset. Otherwise, you can show it separately also, no problem. Okay, show it separately. It is not included, right? So I am including that, no problem. But new asset will have no depreciation up to the earlier year. Up to the earlier year. Balance asset, how much? Otherwise, you can write this way. You can write this way. I just make a slight correction. Okay. Disposed asset and balance asset. The total being 1,15,000, and then you can take with the new asset. New asset being 30,000. Accumulated depreciation on this being 77,625. Net book value of this one being 37,375. 37,375. Is that clear? So 1,50,000, 20,000 sold means 95,000 is the balance asset. You have to find out the depreciation for the disposed asset, depreciation for the balance asset. And depreciation for the balance asset, disposed asset can be calculated this way. How many years are over here from here to here? 19, 20, exactly mid of the year. 1.5 years used, 18, 90, 2 years, sorry, 18th year, 19, this is the first year. 19, thereafter, end of 19, 31st December 19, then here. How many years are there? From 1118 to 31st December 18, 31st December 19, 3620. 1 year, 2 year, half year, 2.5 years. So you have to find out the 2.5 years depreciation on this asset. 2.5 years depreciation. The residual value being 10%. The residual value being 10%. Is that okay? Let's see. Depreciation on asset disposed. On asset disposed. Okay. Cost being how much? 20,000. Depreciation for the first year, 2018. Under SLM method, okay, you have to depreciate over 4 years, 20,000. Scrap value being 2,000, because 10% is assumed to be the scrap value. Life being 4,500 is the first year's depreciation. Then 15,500. Depreciation for the year 2019. Again the same 4,500 will be there. Then balance being 11,000. This is what about the net book value on previous year. Okay. Previous year. And now calculate the depreciation for 2020, which is being the current year. Current year is only 6 months, no 2.5 years. So 6 months means in this half will be taken 20,000 minus scrap value 2,000, a residual value 18 divided by 4, but don't forget to multiply with half to represent only half year, 2,250. 2,250. I am going to post all this value here. Overall, we have 115, out of that disposed asset being 90, balance being 95. Overall, accumulated depreciation being 77,625. Out of that, accumulated depreciation for the asset disposed up to the previous year, being 4,500, 9,000. And out of 77,625, 9,000 is for the disposed, means balance being 68,625 related to the balance asset. And in this year, opening book value, net book value is nothing but cost minus this one. So 20 minus 9,000, the value being 11,000. 95 minus 68,625, what is the value? 95,000 minus 68,625. This value being 95,000 minus 68,625. Okay. This value being 26,375. If you add up that, you will get. For the new asset, of course, we don't have the depreciation for the previous asset. That remains as it is the new one. This is the new one. Okay. And what about the current year depreciation? Current year depreciation for the disposed asset being 2,250. For the balance asset 26,375, you know. For that, how can you calculate? For this, 95,000 minus scrap value being, residual value being 10% on this 9,500. Life of the asset being 4. You have to divide this by 4. So 95,000 minus 9,500 divided by 4. This value being 21,375. 21,375. And finally, for the 30 new asset purchased, you know, for the depreciation being residual value 10% on this 1/10 3,000. Life being 4, so I had to divide this by 4. So 30,000 minus 3,000 divided by 4. This value being 6,750. 6,750. Clear? Now come on. Find out the total depreciation of all the three assets. 2,250 plus 6,750 plus 21,375. The total depreciation for all the assets 21,375, 2,250, 6,750, 30,375. 30,375. Disposal asset, no. For that, what is the depreciation in total? 4,500, 4,500, 2,250. Otherwise, after subtracting the last one, 11,000 minus 2,250, 8,750. So this is nothing but the difference between cost and net book value. Cost 20 and net book value being 8,750, 11,250 will be the accumulated depreciation on the asset disposed. 11,250. Clear? You have to add 4,500, 4,500 and 2,250. This will be the value 11,250. On disposal of fixtures, this 11,250 will go and verify whether any other things are required. In fixture, we need to know only one item. All other are available, so you can tally and find out the balance brought down. Carried on and brought down. So the value being 1,45,000. 1,45,000. Balance carried on being 1,25,000. This becomes balance brought down for the next period. Provision for depreciation, we need to find out only one balance. You can tally and get the balance here. So the total being 1,08,000. 1,08,000. The balancing figure in this case being 96,750. Write it down here, 96,750. Disposal of fixtures. Disposal of fixtures. 20 this one. Now tally, you will get either profit or loss on disposal. I think you have the value higher in the debit side, then definitely you don't have the profit, you have only loss. What is the ultimate value? 2,750 will be the loss on disposal. 2,750 being the loss on disposal. Clear? So here you have to understand and concentrate on what? This depreciation related to all the three assets. All the three assets. This depreciation represents to the assets sold from the date of purchase to the date of sale. Otherwise, it is nothing but cost minus net book value on sale. Okay. One of the comprehensive illustration. Only this model will be applicable for the rest. This is SLM method. Under reducing balance method, you calculate the depreciation only on this. That's all. Rest will be the same. Clear? Come on. Make a note of it. Continue the next illustration. Ahmed sold old office furniture for $1,350 on 3rd January 2023 on credit to Rahat. The equipment had been purchased for this much and all these things are okay. You have to prepare only disposal of office equipment account. So this illustration is a comprehensive one. Here I am going to prepare only this disposal. Then the original value of the asset is transferred from the asset to this place, and accumulated depreciation on that also be transferred from provision for depreciation account. Amount recovered on sale will be posted here, and tally this to find out the profit or loss. That's a very simple illustration. Let's see. I am going to solve this illustration now. Disposal. Carrying 5 marks. Disposal of office equipment. The asset value is transferred from asset account, office equipment account. Accumulated depreciation is transferred from the accumulated expenses to this one. So here, accumulated depreciation or provision for depreciation of office equipment, and either you get profit or loss. In case of profit on disposal will be posted in the debit side. In case of loss on disposal will be posted here. So sold for this much on 3rd January. On credit to Rahat, so we don't have the cash here, we have to write Rahat. The date of sale being 3rd January 2023. The amount recoverable being 1,350. The equipment had been purchased for this much. The original cost $3,200. Ahmed charges depreciation at the rate of 25% per annum using the reducing balance method. So you need to find out the accumulated depreciation. The asset purchased on 1/1/21, cost being $3,200. Depreciation for the first year at the rate of 25%, 800 for the year 21. Then 1/1/2022, net book value being 2,400. Again, this asset sold on which date? 3rd January. So we have to calculate the depreciation for this is 22, sorry. This is for 2021. 2022, we again calculate the depreciation at the rate of 25% on this. So 24,000 into 25%, 600. And 1/1/2023, the net book value being 1,800. But the actual sale date being January 23, matter of 1 or 2 days. So we assume there is no big depreciation for this period. And depreciation up to the date of sale being, you have to add up these two, 800 plus 600, 1,400. So that will be posted here. Now finish up tallying that and find out whether there is any profit or loss. Hope you will get the balance higher. Balance in the credit side, the debit side balance is higher. So I post that value in both the side. The shortage is named as loss on disposal. The balancing figure 450. Hope now you will be able to understand this one. On 30th April 2024, Loti sold a motor vehicle $6,000 on credit to Y Limited. She had purchased the vehicle on 1st May 21 for this much. So what's the requirement? Calculate accumulated depreciation. It's a working note. And prepare disposal of motor vehicles. Very simple illustration. Let me finish up this a bit faster. There will not be any confusions. So in case of disposal of asset account, remember the format. What's that? Disposal of motor vehicle. The asset value is transferred from motor vehicle account, and provision for depreciation is transferred from provision for depreciation account. And on sale, you get the collection, but it is on credit, no Y Limited name is posted. On sale, you will get either profit or loss. In case if you get the profit, it should be posted here. Profit on sale. If you get the loss, it will be posted here. Loss on sale. Loss on sale. You will get one of these two, right? Either profit or loss. So the lottie sold the motor vehicle for 6,000 on this date, 30th April 24. The amount collected or recoverable from Y Limited being 6,000. She had purchased the vehicle on 1st May, 12,000 rupees. Original purchase date 1/5/21. Cost, the amount paid for purchasing this being $12,000. Is that okay? This value being 12,000. It should be shown at the cost value. Lottie charges depreciation on vehicle at 25% using reducing balance method. No depreciation is charged in the disposal, in the year of disposal. Okay. So in the year of disposal, there is no any depreciation charged. Clear? Now find out the depreciation. This was purchased on 1st May and 30th April 2024. Year also closes on this date. I assume that the year may be closed on this date. So 1/5/21 to the year end up to 30th April 22, you have to calculate the depreciation at the rate of 25% on reducing balance method. So which is 3,000, 9,000. This is net book value on 1/5/22. Again depreciation for the next year up to 34/23. On this 25% being 2,250. 5,000, 2,250, balance being 6,750. This is what about the net book value on 1/5/23. But the asset is going to be sold on 34/20/24 sale date, but we don't claim the depreciation in the year of depreciation. No depreciation is charged in the year of disposal. So here you no need to provide the depreciation. Calculate the accumulated depreciation on the vehicle sold. What's the accumulated depreciation? The overall depreciation on the asset sold being 3 plus 2,250, 5,250 will be the accumulated depreciation. Okay, that will be posted here. Provision for depreciation 5,250. All these things are posted on the date of sale only, 30/4/24. Now try to find out the difference between debit side and credit side, and to find out it may be profit or loss. 12,000, 12,000, and here the value being 750. Loss on sale of asset being 750. This is the balancing figure. Is that clear? For this calculation, you get 2 marks. For this preparation, you get 4 marks. Now, Stella charges depreciation at the rate of 25% per annum using reducing balance method. She charges full year's depreciation in the year of vehicle is purchased and none in the year of sold. In the year of sold, no depreciation is charged. On 31st December, so what are the requirement? Stella sold a vehicle this much. This is also okay. Calculate gain or loss on disposal. And the balance on Stella's ledger account also be given. So from this share, we have to prepare Stella's motor vehicles account, also provision for depreciation account. So we have to prepare all these ledger accounts. Clear? So we have to prepare all these things. I need only this one only for my preparation. Okay. I just keep the requirement only here. These are the informations are in need. That's all. We prepare all the ledger accounts here. Already in the very first illustration itself, I gave full format. We'll prepare all the formats and then post all the available information to the concerned places. Okay. So it's all about vehicles, vehicle account, depreciation, provision for depreciation account, provision for depreciation account, disposal account, disposal of vehicle account. Okay. Apart from that, you have to calculate depreciation on asset sold, depreciation on asset sold, asset disposed, as well as you have to calculate the depreciation for the all assets for the current year. All asset here mean whatever the asset disposed and newly purchased asset, balance asset, like cost, accumulated depreciation up to the previous year end, accumulated depreciation up to the previous year end, opening net book value, current year depreciation. In the case of depreciation on assets sold, you have to calculate cost minus accumulated depreciation on the assets sold, or cost minus net book value on the date of sale will be your accumulated depreciation. Right. Working note number 1, working note number 2, and these are the main ledgers. Stella charges depreciation at the rate of 25% per annum using the reducing balance method. She charges full year's depreciation in the year a vehicle is purchased and none in the year of sold. On 31st December 22, Stella sold a vehicle for 9,500, sale value being 9,500. So here I just write the format here: balance brought down, balance carried on, balance brought down for the next period. Bank for purchases, if asset sold, transferred to disposal. In provision for depreciation, balance brought down in the beginning, and income statement. The value to be posted here is calculated in working note number 2, and amount transferable to the disposal account. This will be calculated from working note number 1. Then you will get the balance carried on. This becomes balance brought down in the next period. In case of disposal, this original value comes here, vehicle, and here provision for depreciation. If you get any amount recovered on sale, or in case due means the party's name will be posted. After this, you will get either profit or loss in case of profit on sale, profit on disposal, or loss on disposal. One of these two you will get. Stella charges depreciation at the rate of 25% per annum using reducing balance method. This one is okay. She sold it for 9,500. The vehicle cost being 16,000. Cost should be transferable from here to here. The balance on Stella ledger at 1st January 22, year beginning, 48,000. And year beginning provision for depreciation being 21,000. We don't have any new asset purchased. Okay. Then Here only one is missing. You can easily tally this and get this value. 48,000, 48,000. 32,000 is the balance carried on. So here 32,000 over. In this case, I have to calculate the rest. What about the opening value? 48,000 for all the assets. Provision for depreciation being 21,000 up to the previous year end. And opening net book value being 27,000 net of this. We don't have the new assets in this case, so you can simply score out. The cost of the new sold asset being 16,000. Out of 48,000, sold asset being 16 means balance being 32,000. Non-sold, non-disposed asset we still have. Accumulated depreciation 21,000. Now we have to find out the accumulated depreciation for the asset disposed. Here, this asset was originally purchased on 1st September 20 at rupees at $16,000. At $16,000. You have to claim the depreciation for the year, first year. Okay, up to 31st December 2020. Even the part year, in the year of purchase, you claim the full year's depreciation. In the year of sale, you don't claim the depreciation. So at the rate of 25%, 4,000. Then balance being 12,000. Balance being 12,000. This is on 1/1/21. Sold on which date? 31st December. This is the sale year. Up to 31st December 21, you can claim the depreciation. This is net book value. This is depreciation for the first year. Here again 25% on this being 3,000. Balance 7,000 will be the net book value in the year beginning. In the year beginning. Okay. Now in the year beginning, 7,000 for the year up to 31st December 22. We don't claim the depreciation because it's the year of sale. In the year of sale, they told us not to depreciate. So this is what about the net book value on the date of sale. Now accumulated depreciation being the difference between cost and this one, or 4,000 plus 3,000, 7,000. You can either add 4 plus 3 or 16 minus 7. You will get the same answer. So 4 plus 3, 7,000. So I'll post that value here and here. And out of 21,000 accumulated depreciation, 7,000 meant for disposed asset. Out of 21 is for the disposed asset, means balance 15,000. Means 14,000 is meant for other balance asset. 16 minus 7, 9,000 is the net book value. Current year we don't claim the depreciation for the asset disposed. Current year we don't claim. For the balance asset 32,000 minus 14, 18,000 will be the net book value. You can claim the depreciation on this balance, because we are following the reducing balance method at the rate of 25%. As for the disposed asset, we don't claim the depreciation for the balance amount, 18,000, 25%. 4,500 can be claimable. 4,500 can be claimable. Is that okay? Now overall depreciation for the current year 4,500 is posted here. So that's all. So we have completed the vehicle account. In provision we have to calculate only one. We can easily calculate by tallying this 25,500. 25,500. This balance being 18,500. Rewrite here as 18,500. Now we can close the disposal account also. If you try to find out is there any profit or loss, check whether which side is higher. 7,000, 9,000, 16,500. So you have the balance higher in the credit side, post that value here. This 500 will be called profit on disposal. We don't have the loss on disposal. Now you'll be able to understand this calculations and all, right? 12,000 minus 3,000, this is 9,000. Okay. So if you want to calculate the accumulated depreciation, this way also you can calculate the cost being 16,000, net book value being 9,000, the accumulated depreciation being 7,000. Either you can calculate this way or simply sum these two values to get the 7,000. Clear? You can group all the depreciation amount, or from the opening cost you subtract the net book value. Clear? Now let's move on to the next illustration. Now, Mo is a farmer. He prepares his financial statement to 31st December each year. He delivers his farm produce to his customers in his delivery vehicle. Mo charges depreciation on vehicle at the rate of 20% per annum using reducing balance method. He charges full year's depreciation in the year of purchase and no depreciation in the year of disposal. This sum seems to be similar to the earlier one. So 20% reducing balance method is followed. Okay. And calculate the accumulated depreciation on the delivery as well as disposal account for the sale. So you have to calculate only these two. Other things are not required. So we can finish up just like that. So only one ledger is to be prepared. What's that? Disposal account. Most book disposal of delivery vehicle. Okay. When you sell, you can post the value here directly. Okay. Delivery van cost and accumulated depreciation should be posted to the other side. Provision for depreciation. And any amount recovered, bank or if it is recoverable, party's name will be posted. And then you will get either profit or loss. In case of loss on sale, here. In case of profit on sale, you will get the value here. So loss or in case profit, it will appear here. Profit on disposal. Okay. He prepares his financial statement on 31st December each year. He delivers his farm product to his customer in his delivery vehicle. Mo charges depreciation on vehicles 20% per annum under WD, written down reducing balance method. He charges fully as this one is already okay. The earlier some like he sold his delivery vehicle for $2,900. So amount collected being 2,900. And he had purchased this delivery vehicle in June 21 for 10,000. The cost being this one. So now we have to find out what is the net book value on sale. Okay. June 2021 cost being 10,000. For the year 2021, you have to claim the depreciation at the rate of 20% on this 2,000, 8,000 is the net book value on 1/1/2022. And the assets sold on this date. So you have to calculate for depreciation for this year. Then you will get the net book value for 2023. Depreciation for 2023. Then you will get the net book value for 2024, right? And thereafter, you will not be eligible for claiming. Up to 31st March, we are not going to claim the depreciation. Oh, so year end being what? Year end being 31st December. So up to this year, first year, second year, third year, 3 years already used, completed 3 years. Under WDV method, as a reducing balance method, I am going to depreciate. So for 8,000, 20% being 1600. Then this value being 6,400. Again 20% being 1,280. Net book value being 5,120. Accumulated depreciation on asset sold being cost minus net book value on the date of sale. Cost being 10,000. Net book value being 5,120. Then accumulated depreciation being 4,880. I put that value here. I post this value here. Now find out the difference, if any. The difference comes in the credit side, so I post that value here. So 10,000 and 10,000. This will be called as loss on sale. Loss on sale in this case being 2,220. Balancing figure. Balancing figure. Question number 6. A company has fleet of delivery vehicles. Information from their statement of financial position at 31st December 22 shows that the vehicles originally cost 4,40,000 with accumulated depreciation 2,70,000. Okay. So this is what about the year beginning values. What are the things are required? Calculate depreciation charge for the year. Prepare company's ledger account for the delivery vehicles. Provision for depreciation. Second one. Third one being disposal of delivery vehicles. So these three will be calculated. Right. We'll again open the formats here. Here, full year's depreciation charge in the year of purchase, no depreciation charge in the year of disposal. In the year of disposal, you no need to charge any depreciation. The business provides depreciation using SLM method, straight line method at 20%. So SLM at the rate of 20%. I want only these items up to the first block. Rest will be only requirement. So I keep this in the next page for solving the illustration. Yeah. Now what is a comprehensive format? So we need to prepare the asset delivery vehicle, and provision for depreciation of delivery vehicle, disposal of delivery vehicle. In delivery vehicle, balance brought down, bank for purchases, disposal for the asset disposed. All these things, all these values are recorded at cost, and balance carried down right here as balance brought down. In case of provision for depreciation, balance brought down, balance carried down. Here income statement, and here disposal account. The depreciation, accumulated depreciation on the asset disposed. This balance can be transferred to the next year beginning. And in case of disposal of delivery vehicle, the cost will be transferred here, delivery vehicle, and provision for depreciation on delivery vehicle. Any amount recovered on sale or non-recoverable will be posted here. In case of loss, that will be appearing on credit side. Profit on sale will be appearing in the debit side. Hope now you'll be able to understand this. Better you recollect the two more working notes. One is to calculate accumulated depreciation on the assets sold, cost minus net book value as in the date of sale will be the accumulated depreciation. Another one being depreciation for the current year. Depreciation for the current year for all the assets. Second working note. For this, disposed asset, newly purchased asset if any, and remaining assets remains with us since very earlier period, even today. Cost of these three assets, accumulated depreciation up to the previous year. Okay, provision for depreciation or accumulated depreciation up to the previous year, otherwise opening provision, and opening net book value is nothing but subtracting this one from the cost, and whatever the balance left or no, on that you supposed to provide the depreciation for the current year. This is the format. A company has fleet of delivery vehicles information. Okay, this is what about the opening assets value and depreciation value. We'll start with 4,40,000 rupees being the asset value. 4,40,000. Accumulated depreciation on that being 2,70,000. And the business purchased two additional vehicle costing total 70,000 on 1st April 2023 and credit from L Autos. So it is not bank, it is L Autos. You purchased from L Autos and the value being $70,000. On 31st December 2023, the business sold one of its vehicle. The vehicle had originally cost 28,000 with accumulated depreciation being 16,800. Cost being 28,000, accumulated depreciation for that being 16,800 already given. Then you will get the net book value. So here the calculation is pretty simple. We directly get this value. So the cost of the original asset being 28,000, transfer here, and accumulated depreciation on the asset sold 16,800, transfer from here to here. The vehicle was sold for 10,500 sale value. 10,500 we collected the money to a local garage who paid the bank transfer. Okay, everything is okay. Now what is the net book value? I think 11,200 is the net book value. 11,500, 200 being the net book value. So if I tally the disposal account, I get the higher value in the debit side, means there will be loss on sale, disposal. This value being 700. Now we have to calculate rest of the things. In case of delivery vehicle, only one item, already we have all the three values. So the last value also we can calculate easily by tallying. So 5,10,000, 5,10,000. And this value being 4,82,000. 4,82,000. 4,82,000. Okay. Now here I need to know two details. I cannot find out using the tallying method. Then I have to get one. This one can be calculated using working note number 2. So working note number 2 is already there. So total of the cost in the beginning being 440. 440. And total of accumulated depreciation in the beginning being 2,70,000. Okay, asset disposed. The cost of the asset disposed 28,000. Accumulated depreciation on the asset disposed being 16,800. New asset comes only in this year. The value being 70, not exist in the beginning. So out of 440, 28 is subtracted. So 4,12,000 is the asset exists since very long period. And accumulated depreciation on that being 2,70,000 minus 16,800. 2,70,000 53,200, 2,53,200, and the net book value being here 11,200. The net book value here being opening, okay, 4,12,000 minus 2,53,200. This value being 1,58,800. Okay. For the disposed asset, current year we don't claim the depreciation. For the newly purchased asset, you can claim the depreciation under SLM. No, so you have to calculate the depreciation on the original value. So 20% on this. For this 70, this is the original value. For this 70, 20% 14. For this is a net book value, but we have to calculate from this. The value being 80,240. 4,12,000 into 20%. 82,400. Sorry, 82,400. The total depreciation for the remaining asset and newly purchased asset being 96,400. I'll put that value here, post that value here, 96,400. If I tally this, so 3,66,400 and 3,66,400. Then the balance carried on in this case being 3,49,600. So we have completed all. But here this much of working is also not required because it's being the SLM method. No. Even you can simplify this calculation. How? For the new asset 70, for the existing asset 4,740, you know. From that, sold assets cost is subtracted. Okay. After subtracting, you calculate 20%, and for this 20%. That's all. This is how you can get the answer. Okay. 440 minus 28 into 20% being 82,400. 70,000 into 20%, 14,000 rupees. So you get the value directly. You can skip the second working note at all. This second working note is most important for the reducing balance method because we need to know the reducing balance. Only then we have to calculate the depreciation on this. Under a straight line method of depreciation, you no need to elaborate this working note number 2. You can get the answer just like that. Is that clear? Question number 7. Simon has a business selling office stationery. On 1st January 2019, he owned 2 delivery vehicles. All this is okay, but what are the requirements? Complete the following accounts for each of the years. Each of the years ended 31st December 2019 and 20. You have to calculate the asset account for 2 years. Balance the accounts and so we have to calculate for the 2 years and you have to prepare delivery vehicle, provision for depreciation, disposal account. Okay. So you want only this information. So I'm going to prepare for 2 years. In the books of Simon, delivery vehicles account, delivery vehicle account, provision for depreciation account, provision for depreciation account, depreciation of delivery vehicle account, disposal of vehicle account, disposal of delivery vehicle account. On 1st January 2019, he owned 2 delivery vehicles which had been purchased on 1st January 2018. So I'm going to prepare from 2019 onwards. 1st Jan 19 balance brought down. Okay. The delivery vehicle A had cost 30, delivery vehicle B had cost 25,000. So total 55,000 in the beginning. Simon uses straight line method of depreciation for the delivery vehicles. The rate of depreciation being 20% per annum on cost is used, with the rate being applied for each part of the year for which the delivery vehicles are owned. Even for the part of the year, you have to calculate. The earlier illustration, in the year of purchase, whether you use it whole year or half year or part of the year, doesn't matter. You have to create the depreciation full year. But the year of sale, you no need to create the depreciation. So, but here it is not so. Any part of the year is used, then you have to calculate the depreciation for that part. Due to the decline in business, delivery vehicle B was sold on 31st March 2020, and a check for $10,350 received. So, whenever the asset sold, then at the disposable, means original value will be transferred to the disposal of delivery vehicle account. Anyhow, this happens in the second year. We have to prepare 1st Jan 2019, 1st Jan 2020, but the sale happens in this date. So second year ends on 31st December 2020. But sale happens only in the second year, this date, 31st March 2020. Originally the asset purchased on 1st January. Purchase date being 1st January 2018. We have to prepare for these 2 years. The first year there is no any big complication, so we can easily calculate. There will not be any change. So that becomes automatically closing balance for the year end. 31st December 19, balance carried on. No sale, no purchases. That remains as it is. Is that okay? Next year, 1120 balance brought down being 55,000. Similarly, in case of provision for depreciation on first year end being 31st, first year beginning being 1119, how much depreciation could be there? Okay. We follow which rate of method of depreciation? Straight line method of depreciation, 20%. Actually, it is purchased on 1st January 2019, 18. From this date to this date, the depreciation might have been calculated for both the assets. 30 plus 25, 55,000 rupees on the total value for this period. They might have calculated depreciation at the rate of 20%. 11,000. That remains opening here. Balance brought down. And no disposal happens for the year end 31st December 2019. You have to provide the depreciation transferable to the income statement. Depreciation for this period. For this period also, if you calculate, this is year 1, this is year 2, you have to calculate the same way. For this year also, you have to claim the depreciation at the rate of 20% on SLM method, so 11,000. That becomes automatically closing value 31st December 19. Balance carried on being 22,000. If you tally, you will get 22,000. Am I right? We don't have any sale. In the next year, 1120 balance brought down being 22,000. 22,000. So we got the balances as in the year of sale in delivery vehicle as well as provision for delivery vehicle. We come to this year. Now automatically what happens? You have to do the working note. Which asset sold on 31st March? Vehicle B. Vehicle B originally purchased for 25,000. 1119 cost being 25,000. Depreciation for the year 2019 being at the rate of 20% being 5,000, 20,000. This is what about the net book value on 1120. In the year 2020, again you claim the depreciation at the rate of 20% on SLM. The original value remains same. So then the depreciation also be the same. 15,000 will be the net book value. This will be the value on 1121. Okay. No. This is purchased on 18. This is 18 depreciation. This is 19. This is 19, right? This is 2019 depreciation. This is all about 1st January 2020. But the sale happens on 31st March. So up to 31st March 2020, you have to claim the depreciation. Part of the year will be eligible for the part of the depreciation. So 25,000 into rate of depreciation being 20%. From here to here 3 months. So you have to calculate for the 3 months. If you calculate for 3 months, I think the value being 1,250, am I right? The net book value on sale being 13,750. Now, what about the accumulated depreciation on the asset sold? Cost minus net book value on sale. Cost 25,000. Net book value being 13,750. Then the depreciation on the asset sold being 11,250. Or it is nothing but summation of all the 3 years depreciation on the asset sold. When the asset sold, the sold assets cost is transferred here. 31st March 2020, delivery van amount recovered, means the sale delivery van, delivery vehicle. On the same date, accumulated depreciation should also be transferable. Provision for depreciation on the delivery van, of delivery van. And the amount recovered on sale being 10,350, bank 10,350. Now, this amount is transferable from here. 31,320, disposal. The value here being 25,000. The original cost will be transferred. An accumulated depreciation on this delivery van is transferable from here to here. 31,320, disposal. This value is already calculated 11,250. 11,250. Now, if you tally, then you will get either profit or loss. I think you will get loss only. 25,000. 25,000. In this case, the loss being 3,400. Loss on disposal. So now I have to close the delivery vehicle account. If I close year end 31st December 20, you get the balance carried on being 30,000 rupees. 55. After subtracting 25, balance carried on being 30. 1121, balance brought down also 30. This is nothing but the vehicle number 1. Vehicle number 2 is discarded. While closing the provision for depreciation for the year end, you have to calculate the depreciation for all the assets. 31st December 2020, income statement. How do you calculate this? The depreciation will be for all the assets. Disposed asset, newly purchased asset, or balance if any. Which asset is disposed? B is disposed. Balance asset being A, no new purchases there. Disposed assets, the sale year's depreciation being 1,250. Balance assets value being 30. On that SLM method, no, 20% on that being 6,000. So the overall value being 7,250. 7,250. If you tally, then you will get the balance carried on. 29,250. 29,250. Balance carried on for the year end 31st December 20 being 18,000. This is the overall depreciation for the leftover asset A. 1,121. Balance brought down 18,000. Balance brought down